Welcome to This Week in Money. I'm Jim Goddard. Today, Warren Pollock on why high-frequency trading is no longer relevant, Robert Campbell on the importance of timing real estate acquisition and sales for maximum profit, and David Smith on the risk factor going down for investing in gold. We'll talk to Warren Pollock right after this.
The best of the best, Randy Elvis Frisky and his Las Vegas show band with Cassandra Frisky, remembering Elvis Presley on the anniversary of his passing. Bell Center in Surrey, August 16. Cultural Center in Chilliwack, 17. Details at randyelvisfrisky.com. Welcome to This Week in Money, the source for market opinions. Sitting in for Phil Mackesy, here is Jim Goddard.
Welcome to This Week in Money. My guest is Warren Pollock, Wall Street insider, perhaps. He's also known to people who listen to the Kaiser Report, CBS Radio. I guess the thumbnail sketch of you would say you're a financial geopolitical analyst. And you also helped work on the development of Wall Street's high-frequency trading network, which now is the standard in the industry. We'll talk about its future in a second. Maybe, Warren, we'll take a look at gold. Everybody's wondering what's going to happen with it. The prices just don't seem to get out of pretty well what the cost of production is right now.
Well, do you want the good news or the bad news?
We love the best news.
Or a different way to see things. Okay.
Yeah.
Well, let me give you a different way to see things. Why don't we call gold a transition metal? And what do I mean by that? What I mean by that is that gold will help you transition through any kind of uncertainty that is on the horizon. And I think times are due to become more uncertain. The knee-jerk reaction on a lot of people is to monitor the price of gold very closely because it's something that they invest in. But perhaps it's the right time to start to look at gold as something that will see you through a crisis, assuming, however, that you own real physical gold.
And that's one of the problems that a lot of people don't understand is what you see on the board every day on the business news isn't the actual price that you pay for a chunk of gold, is it?
No, it's not. And really, there's a lot of paper gold that's there, which is in the form of ETFs and other synthetic instruments. And when we look at things right now, there has to be a general assumption that we're going from a point in time where money has been readily available to a lot of people worldwide, and we have to think that that money supply is on the verge of contracting and collapsing. And really, to a lot of people that are investing in gold, they're looking right now for a hyperinflation. And that hyperinflation may not come about until such time that there is a currency collapse of some sort where the dollars frankly become worthless. But as far as I can see, there's really a global shortage of dollars, and there's a lot of dollars which are going away at every turn. We look at some place like Cyprus, and I was on Max Kaiser's show where I predicted a bank holiday in Europe, and not so far after that, we had the Cyprus event. And all of that money, which is the savings that Cyprus had, is wiped out. Or we look in some place like Detroit that's declaring bankruptcy. When they declare bankruptcy, the people that had all the money in their pension accounts, that money is now gone. And what the Federal Reserve and what central bankers worldwide, and really they're all part of the global U.S. empire, what they've managed to do is to try to push up against this great deflationary force by printing money and injecting it into the system. And everyone knows that the person that's on the ground has not been the beneficiary, for the most part, of this money which has been pumped in. Instead, we have consumers who are simply maxed out. They're really spending money to the point where it's not cash that they're spending, but they're cash flows that they get from work and the cash that they can generate by obtaining loans through credit installment agreements and through credit cards and elsewhere. And as we know, salaries have remained mostly flat throughout the United States and some parts of Canada. The only places that look right now in the U.S. to be very robust are some places on the West Coast, Washington and New York, which have been the beneficiaries of these great inflows of money.
The governments keep calling this pumping out of constant money quantitative easing. What should they really call it?
Well, I think it's delusion. That's really the proper name for it, or denial. You might think of it as kick the can down the road. That's really what the people have been looking to do in the places such as the controller of the currency and other institutions. They want to protect the system, and first of all, they want to protect their own jobs and the special deals which they've given themselves. But also, they want to make sure that there's not wholesale unemployment throughout the United States. So what this quantitative easing has done is it's kept a lot of inefficient businesses in place, mostly in banking and finance. And when you look at the historic level of asset turnover, it's gone up geometrically over time. So maybe an asset was around World War II, maybe turned over, let's say, twice as much as GDP, or ratio to GDP, maybe 2 times as much as GDP. But now, with all the trading that's going on, there is a tremendous, massive turnover of assets internationally, and that's creating a lot of noise. And frankly, everything now in the United States is financial. There's no such thing as healthcare. It's health finance. There's no such thing as buying an automobile on a 72-month lease. It's finance. Everything in the United States is in financial terms. And finance isn't something which is accretive or additive to your economy. It simply is something which is illusory. It draws down your economy.
People who relied on high interest rates, I guess, to fuel their retirement savings or just their ordinary savings account, we've seen that disappear with very low interest rates. Maybe they've just given up on the hope of, gee, save money. I might as well go out and spend it and get a big loan because the loan doesn't cost much.
Right. Well, I think that's not the case. I mean, if you look at the banks are getting 0% interest rates on their loans, but try getting a car loan that's not through some sort of incentive program, or try to get a mortgage. And you can see that there's a big difference between the interest rates which the banks have to pay to the Federal Reserve and elsewhere, and the rates that you have to pay, and that's if credit is available. Of course, the solution or solution path would be to allow interest rates to rise. But if you did that, then all of a sudden you would have more dislocations in the economy. The government wouldn't be able to service its debts anymore. But right now we have, let's think of interest rates in terms of risk-adjusted rate of return. So you can put your money in the bank, and is it really safe if there are bail-ins that occur in Cyprus? If you put your money in stocks, perhaps the stock might double. But what is really the risk that holding a stock entails? And who exactly is holding a stock? And why has the stock market been going up, even though the economy has been very stagnant?
Where is all that money going into the stock market going to then?
Well, I think that I think the right question is, where is that money coming from? So, and where are the solid positions of people that are holding stocks? So if we think about stocks going up because there's more buyers and sellers, we have to think in terms of instability and stability. In the United States is relatively stable compared to Cyprus, or compared to the Eurozone, or compared to a radioactive Japan. So it could be that money is flowing from all of these different extremities into the core part of empire, which is the United States. And additionally, there's money which is locked into pension plans. So pension plans may be allocated either to stocks or bonds, and sometimes they have some innovative financial products. But they buy a stock, they hold on to it forever. They buy a bond, they hold on to it forever. And all that money is captively locked into a system which is not for your benefit as an investor, but it's locked into risk for the benefit of that money being under management by a very elite small group of people. And that small group of people have realized that there's really no money to be made in equities or bonds, and they're just making up derivative instruments to trade amongst themselves at a record pace, with high-frequency trading, frankly, being something that is no longer relevant. And we could see also, besides the decline of high-frequency trading, which is used to be thousands of shares traded in an instant for a penny's margin, now that margin is shrunken down to fractions of a cent. So there's no money to be made in high-frequency trading. And I know this because I talked to one of the managers of a high-frequency trading operation who's getting letters from the SEC asking him to describe all of the different things which he's doing to trade. So there is no merit or margin in professionals trading bonds or stocks at this point. It's just something that's a retail product, and the bag holders, for the most part, hold these retail products in the portfolios that are held in pension plans and other captive money. So what's going to happen next? And I don't think it's going to be bail-ins. I think instead you're going to see the savings that people have accrued in pension plans over time used to try to buy more time for the government. So it's very likely that at some point a lot of the money that's just captive in pension plans will be allocated to U.S. Treasuries and other sovereign debt, and that's try to extend this fraud for yet a little bit more time.
In other words, just like they did in Cyprus, dip into your savings account. This time they dip into your pension fund?
Well, it's different than what happened in Cyprus. In Cyprus, they're having what's called a bank holiday or a bail-in, where all of a sudden you wake up one morning and instead of having $100 in the bank, you might have 60 or 50. What they're going to do now is a little more sneaky in the United States, which is all of people's money has been locked into pension plans. And all of a sudden, these pension plans, let's say I think we're going to have some sort of a shock or adjustment that should be right on the horizon, as far as I can tell. And when we have this kind of adjustment, all of these pension plans, a few of them will have to announce that they're insolvent. And to protect the public, the government will say, and I want to use that word in quotes, protect the public. They're going to say, well, you can't have your retirement savings in the speculative types of financial instruments. It's got to be in safe U.S. Treasuries.
In Canada, we've seen that already, where people want to get into venture capital. If you're 65 or older, the government says, it doesn't matter if you're a millionaire or a billionaire and know what you're doing. You're not allowed to speculate with your money anymore.
Well, that's right. And that's something which could be used to keep the fraudulent system running, because it creates demand for pieces of paper which would otherwise have no demand. And that's the U.S. Treasury. And right now there's money which is flowing into the United States because it's the least ugly girl on the block. So compared to Europe or Japan, the U.S. right now is relatively stable, and it's stable because the U.S. is the center of an empire, and it's stable because the United States has a reserve currency, which is really collateralized by its military projection worldwide. And you see the collateral of the United States failing at the periphery or at the edges of empire when you take a look at places in the Middle East, the so-called Arab Spring. That's the U.S. reserve currency becoming less effective because the U.S. military has abandoned that part of empire. And that empire has tentacles that are spread around the world. And we know that right now because we have someone such as Snowden who's snowed in over in Moscow and he can't leave. Why can't he leave? Because the U.S. can assert empire all the way up to the edge of the Russian Empire.
Well, yes, there was word that perhaps he would be getting a ride to South America with, I think, maybe the Bolivian president or something. And I think the U.S. made it very clear, you're not going to have air clearance to leave Russian airspace.
Right, and if you look at the United States, it's also affecting how other central banks are acting. It's also affecting how agriculture is grown abroad and then imported into the United States. They're sending agents of the United States out across the world to sort of control the standards that these countries are using to grow food or to manage their financial systems. So this is truly an empire, but the empire, the fringe of the empire, the periphery of the empire, is eroding, and it's going to eventually work its way from the outside down to the core of the empire. And we've gone, I think, from a trend which is towards globalization, and now we'll reach the top of globalization, and then we'll go to an idea of a more localized type of global economy. And the problem is with a localized economy is that we now can't support ourselves without all of these connections that we have in a globalized economy. So if you look at Egypt, they can't grow their own food. If you look at the United States, we might import, quite a bit of food. We certainly import manufactured goods. So if we go local, there'll be great pieces of the economy missing. And that gets us back to where we started with gold. I wouldn't worry so much if gold went down to $1,000 or if it stayed at $1,300. Generally, it looks to me like it might go down in price. However, it doesn't really matter because it's going to help you ride the tremendous instability that's going to occur in the near future. And I would think my guess has been consistently that we will see more of a general recognition that things are not going well around 2015, late 2015, is where more people will probably be aware that nothing has been fixed and nothing has been rectified. And there's a lot of people already aware of this. Mostly, I've talked to a lot of people that are 21 and 22 that are trying to enter the workforce, and these people know, the young folks know, that no place exists for them that in the current economy. They're trying to buy time by getting master's degrees, by becoming enslaved, in debt, and they're looking for the American dream that no longer exists. And even, you know, I used to live in Montreal and own some rental property in Montreal. And I've seen Canada gravitate more towards the United States in terms of its culture. It used to be more distinct maybe 5, 6, 7 years ago. And the problem is, I think, that it's a dead end. I think Canada was more effective, and the people would be a lot happier if it had its own cultural integrity, instead of trying to be absorbed to the same standards of aspiration that people in the United States have, because those aspirations are not going to be met. Those wants are not going to be met in the United States. They're not going to be met in Canada, and they're not going to be met in China. Out of the three, Canada, of course, has more resources, which, you know, puts it in an enviable place. But resource economies like Saudi Arabia, you know, show you just how that resource wealth can be sort of a double-edged sword.
Warren, always a pleasure to have a person with your knowledge and background, and I'll try not to have nightmares, but I scare easy.
Well, I think you should be scared easy, but gold may help you transition that fear.
My guest has been Warren Pollock, financial geopolitical analyst, and a frequent guest on programs like The Kaiser Report and CBS Radio. Thanks for being here.
Great to be here.
Always consult your investment professional before making any investment decision.
My guest is Robert Campbell, author of the bestseller Timing the Real Estate Market and other best-selling books on real estate. Welcome to This Week in Money, Bob.
Hi, Jim. Happy to be here.
Well, we're wondering, with real estate prices always rising, going down, what's the market going to be? Is it local, or do we have to worry about the global situation?
We have to worry about both. That's a great question, Jim, and we do have to worry about both. But first off, the local situation here in the United States, the trend is clearly up, as everybody knows, and the way that I figure trends and forecast markets is it's 100% data based, and my market indicators, 5 key market indicators that I present in my book, Timing the Real Estate Market, I rely on those almost exclusively for calling trends and trend changes. Those called an up market back in, for the United States nationwide, back in early 2012. And the trend is not only still up, but it's accelerating on the upside right now, Jim.
Good time to buy real estate in the U.S.?
That's a good question. I think you can buy, my theory on investing is you can buy at any point during a uptrend, but you better know when to sell. So that, this thing could last a year or 2 or maybe 3 years. Nobody knows for sure, but there are some signs that we could be headed for trouble here in the not so near future, and that's especially if interest rates keep ticking up. And the 10-year note, Treasury note in the United States just made I think it's a 15-month high again today. I think it closed at 2.73%, and so that's been a new high, and it's been ticking upward, steadily upward for the last 2 months.
With that trend, so really what you need in real estate is some kind of a stop-loss program like you have on the stock market.
Absolutely. And in fact, what I do in real estate is that because that I believe, and now we're talking not only real estate, but macroeconomics. I think the macroeconomic scene has so much risk involved in it. I'm advising a lot of my followers to use a REIT trend following strategy that I used, so that you have some liquidity, and when the trends change, you can get out and protect your capital, Jim.
Right, a real estate trust. works
right,
well.
A real estate investment trust because of the liquidity. But that's a great question. Should you invest right now? That, you can get on an uptrend at any point in time, like especially in the stock market, any liquid type market, bond market, gold market, liquid markets, because when the trend changes, if you've got your hand on the pulse, that you can get out in a day or two and protect yourself. The thing with real estate is, if you're not tracking this stuff really closely like I do, getting out, you're not going to get out in 24 hours. It might, and if you happen to hit this thing just wrong, where we have some kind of international crisis, like a foreign exchange crisis or something, or a crash in currencies, or a crash in the U.S. dollar, I mean, you're just stuck. But that's left up to each individual's, appetite, for managing and accepting risk. But from a standpoint that if you can afford a home to live in, and you've got good stable income, and that I think now is a great time to buy a home at these low interest rates. Because we all have to, look, a home isn't an investment, but you got to live somewhere. So
I was just going to ask, when you acquire a home, do you have to make that decision? Is this a place where I want to live, and I don't really care if the prices go up or down? This is where I'm going to raise my family.
We all have to live somewhere, Jim, don't we?
Yeah, but we know there are people. Well, it's an okay place to live, but I really intend to make a profit on this.
Well,
so do you have to decide when you're going into it? Am I doing it just for a home, or am I looking at this as an investment that I can sell for more money later?
As the former, this is a home, and come hell or high water, you're going to stay in that home, and that's where you're going to take your stand. I think that's fine. As opposed to a pure investment. Investment's in something that you get into and out of to make a profit. A home, yeah, you'd like to do that, and I think this is a good entry point because of the interest rates, the low interest rates. However, that, if your home, fell, 35% in value, you just have to look at it and say, hey, so what? I mean, a home is different than an investment. It's more of a consumer item that, like food and energy and water.
Well, we know that people walked away from their homes in the U.S. when the property values fell to less than what the mortgage was worth. But could you not go to your lender and say, my house isn't worth that much money anymore? Can I renegotiate my mortgage? Is that possible?
Well, it's possible, but they're not doing that, Jim. They're just flat out saying, make your payments. And in fact, here in the United States, interestingly, and this data is dated about 6 months, but there were 15 million homes that were underwater, and 90% of those homes that were underwater were still current on their mortgage payments, Jim. And the average, and even though, it's less than that now, and the average, the average amount of value that they were underwater by was $75,000. But nevertheless, 90% of all borrowers were still keeping their loans current, as opposed to letting them walking away from those loans. Don't you find that really an interesting statistic?
Well, people were willing to put their lives on the line for their real estate, if you remember back in the 1800s when the West was being developed. And I think they stood by their homes during the hurricane, and they don't want to leave. This is where their families are. That's where their friends are. That's where their kids go to school. That's where their friends are. They've put roots down. Why?
Right.
I think.
And most of these homes are owner occupied, Jim. They're not investor properties. Like if you're $200,000 underwater on an investment property, I don't have the exact statistics, but I know a huge percentage of those were the walkaways.
For
they
sure.
Just walked away.
Yeah, and if it's damaged, talk to the insurance company, get all the money out you can.
Well,
and see
to a large degree, most of those people during the bubble that to get a loan, you didn't need, it was all stated income and you didn't need a down payment. So, you didn't have any skin in the game. So what's the problem walking away?
In Canada, we never had that crisis. The banks here have always been super tough on approving a mortgage, and they've made the rules even tougher when it wasn't necessary.
Your real estate market's still holding up, isn't it?
Yes, it is.
Wow,
and people are
I know.
scared in Vancouver or Toronto that they're going to see something that happened like in the States where major markets saw their homes
what's going to happen? That we've been talking about the Canadian real estate market and how it's poised for a fall. That and I still think it will fall. But you know what it's going to fall? It's going to be during the next financial crisis, global financial crisis, for that the U.S. is going to take us down into, because your economy is so dependent upon the U.S. economy. Even though you've got lots of oil, you've got oil up there, which is great. It's expensive oil, but it's still oil. But I think that easily within the next 5 years, this whole thing's going to have an economic reset, and that's the macro factor. It's not all based on local real estate conditions. That we're going to have a major rebalancing back to normal with all the global economies.
Are there real estate markets? Are there real estate markets where what happens on the outside, it really doesn't change? Because I'm taking a look at a place like Vancouver. The greater Vancouver area, attracts 40 to 50,000 people a year.
Right.
They're all going to need a place to stay. So would real estate in a place like that be more stable than in a market where people can just come and go and the city isn't restricted in size by geography? We have mountains, the U.S., and the ocean.
Well, I can't comment on that because I don't know the Vancouver market that well. The city and that. I heard it's a magnificent place.
It kind of is.
As you know, my degree is in economics, and that's just what I do all day, study economics.
But are there certain markets where, I'm thinking London, Tokyo, major places like that, where no matter what happens, there's such a big entity all on their own that they kind of stand on their own?
No, I do know Tokyo because I've studied Japan quite a bit, and since their credit market went bust, the stock market and real estate market went bust in 1989, housing prices in Tokyo have been steadily down for over 20 years, and I think they're down 40 or 50% from the peak.
So even big markets can get nailed.
Well, Tokyo sure happened with Tokyo. And I know from a standpoint, you mentioned London. Hey, London is in as much trouble as any of the of European countries, and as much as the United States.
So
these guys are all these fiat currencies that they're just pumping out money, to keep the wheels on the car. Eventually, that's going to have consequences, and it's probably going to have consequences in the foreign exchange markets, where you're going to see people at some point. It's a pure confidence game that they're just going to go, look, we know you guys can't pay this stuff back, and they're going to dump this stuff. People are going to start dumping foreign currencies. And I don't know whether it's going to be the euro, the pound, the yen, the U.S. dollar, or even something else. But that's what's going to trigger the consequence that's going to set us back to normal, bring us back to normal in this world where the fiat dollar system that we have right now, or fiat currency system, is going to have to be revamped where it's backed by something.
My question now is, in China, the central government has ordered regional and local governments not to approve any more real estate projects for the next 5 years. And they have those artificial cities built for 600,000 people that have 400 residents in them right now. What does that mean to real estate?
Well, I'll tell you, I'm not really sure what that means, to be honest with you. I just know that it's with any of this information that's coming out of governments, Jim, that a friend of mine that's really smart, and I asked him the other day, I said, what this information that's released by governments all over the world, I said, do you think 1/3 of it is accurate? And he goes, is accurate? And he goes, I think you're high. So we don't know.
And of course, with China, every decision's made behind closed doors. You have no idea.
Absolutely.
And what is their long-range plan?
And especially so in China, to a large degree. So I really don't feel qualified to comment on that. And that's why I'm more or less have tied my horse to pure data. And even though the data is manipulated, at least it's reflective of market conditions, right?
That is the accurate data. Yeah.
So I learned that a long time ago. That data speaks 10 times more loudly than opinions, even though we would like to speculate on things. But, I know the stuff that's coming out of the United States, that these numbers are all manipulated and doctored to a large degree. And I'm sure that's the same in China. I'm sure that's the same in Japan. I'm sure that's the same in England and Europe.
And you're trying to base your decisions on data. Can you rely on private sources, or just take a look at the markets, and that's really telling you what's going on for real?
like what I use to track real estate trends, for example, I use 5 key pieces of data. I use existing home sales, new home building permits, foreclosures, notices of default, and interest rates. Now, interest rates are certainly manipulated down by the government, by the Federal Reserve right now, and that's certainly affecting the supply and demand dynamics that we're seeing here in the United States, where demand keeps increasing because interest rates keep going down. But if you use that, we can get reasonably close. That data is much more difficult to manipulate than, let's say, GDP data.
Well, we'll keep watching the numbers, Bob. Thanks a lot for being our guest here on This Week in Money. After the break, David Smith on This Week in Money.
More and more people are looking to the internet for intelligent, riveting, and thought-provoking interviews. To advertise on the Goddard Report and TalkDigitalNetwork.com, call 604-699-8600, 604-699-8600.
My guest is David Smith. He's the senior analyst for the Morgan Report, which you can find online at silver-investor.com. Welcome to This Week in Money, David.
Good to be back, Jim. How you doing?
I'm doing great. One of our questions, of course, is gold. When is it going to start going up? Do you feel it's pretty well at the bottom as far as it can go right now?
Well, I think that we are really in an area where the risk-reward is very good, and, you hate to say, well, this is the bottom, because nobody really knows until sometime later, but I really believe that the risk-reward is very good in here, and I'm much more comfortable looking at the possibility of a $100 or $150 drop after what it's done than what we did before when it ended up 400 or 500 lower. So I think that the tea leaves are starting to show that the risk reward is getting better all the time.
Is there market manipulation going on by the big players, countries like China, India, the U.S., and some of the big banks who hold a lot of gold?
I think this is sort of thing is just kind of ongoing all the time. Someone said that once that there are no markets, they're just manipulations, and there's a lot of truth in that. And yet at the same time, Mr. Market has a mind of his own, and there are millions of us who are out there doing our buying and selling, and so we have an effect too. And it's just hard to tease out which is doing the most at any given time, but it's all part of the mix.
So many people keep expecting the huge equity market gains that we've seen lately with the NASDAQ at a 13-year high, the Dow and Standard & Poor's hitting record highs. Sooner or later, this thing is going to crash, and gold will be the savior again for so many people.
I think it will, and it's difficult for those of us in the resource sector buying stocks that are declining in price, even though we know they're good ones. But we are also buying out-of-favor sectors here now, and when everybody is on one side of the boat, so to speak, or one side of the trade, at some point the boat gets kind of unbalanced. And so, we saw the Dow up 150 points earlier today, and we'd love to see gold and silver doing the same thing, but the reality is that they are going to be doing that at some point, and so we just have to be patient. And what you and I have talked about for a couple of years now, the idea of not going all in on a trade, buying in tranches, of saving some money back when prices go a lot lower than you thought. And on several of the stocks that I hold, they've done just that. And I know that if I had been buying everything I could at a certain price point, much higher than it is today, I would be pretty discouraged. But now, I don't like to see them going down, but at the same time, I get to buy more of my favorite stocks. And some of them have actually turned around. I mean, I have a couple of holdings that are several dollars off the lows, producer stocks. So there's indications that the market is putting in a substantial bottom here.
One piece of advice you told me once that you gave to your son was, if you bought an ounce of silver every month, in 10 years, you're going to have yourself quite a little nest egg, and it doesn't really matter what the price was when you bought it. Take a look what you have 10 years later. Do you still give that advice out?
I really do, and I think that that's excellent advice for either buying the physical, which is what it's mostly applied to, but also the mining stocks too. You just think if a year ago you said, okay, I have a certain gold producer that I like, I don't know where the price is going to go, but I'm going to buy 50 shares every month, and you did it no matter what it did. Well, I think you'd be pretty happy now because you would have bought that stock might have declined every month for the last year, but by golly, you still kept buying, and you now have much lower cost average. And if you have that kind of an attitude, you're not discouraged when the price goes down. You almost hope it will so you can buy more. And of course, you hope it'll go up at some point, and it really will. But since we can't time the bottoms and we can't buy at the bottom, I think this is one of the only ways that we can really do it to get it right. And then when it turns around, we're going to feel pretty good.
I think when it comes to precious metals and real estate, you tend to see the best gains if you're patient and wait a while and see what happens instead of trying to make the quick flip and the quick profit.
That's really true. Some people are trying to do that now that housing prices have rebounded a bit, and they're probably doing some of that in the Dow stocks as well, too. But getting a position at a good price, averaging in, and then holding on for a big chunk of a particular leg up is really the way to make significant money and hang on to it. And trying to do flip trades and things like this and get really cute with the different moving averages other than using them as tools rather than as strategies, I think is maybe not the best way to go about it.
I heard from an analyst in the gold industry say now is a good time to buy for one reason. All these major mines are shutting down for maintenance and repair because pulling the stuff out of the ground isn't really worth the cost of it. But he said, you know what that's going to cause? 3 years from now, you'll be lucky to get your hands on decently priced gold, silver, or copper.
That's true, and I don't think it's going to take that long because the market anticipates things going forward. So, we're looking at this process that you're discussing, which is starting to evolve now, but the market isn't going to wait 3 years and go, oh, I'll reprice everything. It's going to be taking place. It's actually taking place now because some of these big companies are having huge write-downs. Barrick wrote down $8 billion worth. It's just a classic example because they're one of the biggest outfits out there, and there are several other majors that have announced billions of dollars of write-downs of projects that they paid too much for or that are uneconomical in this environment or all sorts of things where they've made mistakes. And they're now getting their ships back to a lean, mean situation, and people are starting to respond by buying these stocks.
More with David Smith next on This Week in Money.
The best of the best. Randy Elvis Frisky and his Las Vegas show band with Cassandra Frisky. August 16th, Surrey. 17th, Chilliwack. September 14th, Kamloops. Details at randyelvisfrisky.com.
Welcome back. I'm Jim Goddard. I'm chatting with David Smith. Barrick Gold announced an $8.7 billion quarterly write-down, and dividends for the quarter were down 75%. And I was wondering, is that good news for investors or bad news?
Well, it really is because investors are seeing Barrick, and I'm using them as an example because we're discussing them, but we could put a dozen other names in there too. That management is coming to terms with the reality of some of the mistakes they've made in the changing market environment, and they're getting to a position where they can be profitable again. And if you look at Barrick stock, it's up several dollars over the last couple of weeks, so people are responding favorably to what they've been doing rather than them trying to do more of the same, which wasn't working before.
I know there was a huge argument, should we fire the board of directors or not?
Well, they lost their CEO. He lost his job, and other companies have gotten rid of their board of directors, in either partial or complete changes. So these are the things that need to be done, and it's just part of the cycle. And the companies that do this will be lean, and they will be, in a good position to do well when the market turns. I mean, I know a couple silver producers that have either shut down part of their operations or all of them in the case of maybe one that only had one or two mills going. But these are high grade operations that have very good grades and very good resources and reserves. And their price has just been decimated because they're not producing now. But you know what? They're continuing to go ahead and modify their procedures and to be able to introduce higher head grades when they start back up again. And when prices turn around and silver gets up into the mid-20s and up toward 30, these companies are going to open back up again, and their prices are going to be, their shares will be 4 or 5 times higher than they are now. So if you are looking at a company that is not, you don't think it's going to go under, and they're doing the right things and they're being conservative, you should consider buying some more of those shares because you will probably be rewarded.
Should you also take a look at the geopolitical situation for these mining companies? I know with Barrick, it's the Pasco Lama mine on the Argentinian-Chile border still shut down for political and legal reasons. Should you take a real close look at what's happening where these people have built their big mines before you put any money in?
Geopolitical considerations have to be high on your list because you can have the most fantastic project in the world, and there are several out there right now that have really good metrics if they were in a safer jurisdiction. But because of the questionable policies and social issues and things like this, and environmental issues, questions on the project, it really puts them into question whether they will be able to open up at all. And so what good is having a tremendous project if it never gets to come on stream or if it gets nationalized? So geopolitics, to me, it's like location, location, location for regular real estate. It's pretty much very similar situation with regard to a gold and silver or platinum palladium property. I mean, look at South Africa if you really want to see that in spades, what we've been discussing here.
Yes, of course they have all that valuable product in the ground, but will they ever get it out without a massive loss of life?
Well, there you go. And, Jim, in the case of South Africa, we're not talking about a country that is nationalizing projects from foreigners that have come in and built the mines. A lot of those are indigenous operations that have been there for many, many years. And so it's a combination of the labor unions asking for, some cases, a doubling of wages, when they were already producing metal below the cost of where it is now, below, what they can get for it. But then you have the government adding more taxes into it. So it's like nobody gets it. People aren't going to stay in business if they lose money with every ounce that they sell. At some point, they're going to say to heck with it. And you're just going to see a continued downward spiral in the production of gold and platinum and palladium in South Africa as long as they continue these policies.
Chris Marchese, the mining analyst for the Morgan Report, pointed out in a show that we did that zinc mines, zinc, he says, is going to become precious because the 4 major zinc mines in the world are going to close in the next few years, and there are no major projects online right now, and zinc and silver are closely connected.
That certainly is a possibility, and, Chris has done a couple of incisive reports on that topic, and I think he's got something really significant to say about the zinc issue. And, of course, zinc and lead are common byproducts, not byproducts, but common base metal attributes that come from a lot of silver production, even from mines that have a lot of their money coming from the silver itself. You still have a lot of lead and zinc, and so they will continue to contribute zinc to the supply part of the matrix, but by the same token, you do need to have large projects to cover the basis for the overall demand. So it'll be interesting to just see how some of these base metals supply-demand matrices develop over the next few years. Copper is the same way. I mean, if you look at the copper that is supposed to come online over the next 10 years, we're going to be just fine. But if you back out these projects that are very questionable due to geopolitical concerns or cost of production, suddenly you look at more than half of the copper that is expected to come on stream that is very questionable whether it will at all. And over the next 5 years, I believe there's only one new copper project that is slated to come on stream worldwide. So, copper could go lower from here, maybe substantially lower, but the point is it'll be setting itself up for a substantial increase in price a few years going out.
David, thanks a lot for chatting with us.
Very good. I always enjoy talking with you, Jim. Have a good day.
Thanks to our guests, Warren Pollock, Robert Campbell, and David Smith. And thank you for listening. I'm Jim Goddard for Phil Mackesy. We're back next week with more This Week in Money.
This Week in Money is a production of Howe Street Media Incorporated.